As it's Thursday afternoon, we're going to do something a bit different. First, I'll introduce myself. My name is Miguel Burguet, and I'm the managing director at Marlowe Capital. We are a macro fund focused on the banking sector. We are the first ever spin-off from the financial department of the London School of Economics, a mix of scientists and people from the industry like me. And we are closely linked to the Systemic Risk Center of LSE, which is one of the most advanced research centers in the world on macroeconomics applied to the financial sector. So that's what we are going to talk a bit. Right now, we are going to go through our macro-financial vision in the Western world, in the US and Europe, and then we are going to talk about the big elephant in the room that could change very significantly the financial sector during next 10, 20 years, which are the central bank digital currencies. At the same time, we'll try to identify some candidates for long investments, and we'll see probably some of them as well for a short. So we'll start with the United States. Economy, we believe, is ready to expand. Banks and the shadow banking sector are ready to lend. Macro variables are on the path of control. Inflation is 3.2%, still a bit over the official 2% target of the Fed, but the unofficial one should be close to 3%. So with inflation under control, you will get pretty quick the macro picture under control, and you got the United States ready for growth. What makes us think that we are at the start of a 4 or 5 years of expansion of the north of the American economy, the US economy, and as well the Canadian economy? Two elements. The first one is the return on equity of the US banking sector, which is around 9.5% right now. If you look at values at the upper part of the cycle, it's around 18 for commercial banks, over 20% for investment banks. That means that US banks have a lot of dry powder to lend and throw gasoline into the recovery of the economy. The second element that we think will help enhance this US expansion during next years is the shadow banking system. The US shadow banking system, hedge funds, pension funds, prop trading houses, et cetera, is, as is widely known, probably the most extensive in the world in relative and absolute size. And we believe that when banks start investing, start lending to the economy, the shadow banking system will follow suit. Why? There is some very recent and interesting research that tries to understand how the shadow banking system in the United States works. You got it here, margin debt capacity and systemic risk. So basically, if you are a big US hedge fund, you are expanding your balance sheet on the margin. And that costs money. You borrow money, you grow your balance sheet, you pay the interest rate. That, for the aggregate system, means that the higher interest rates are, the smaller will be the balance sheet of the shadow banking sector. The other way around, when interest rates goes down, you as a big hedge fund manager, as a pension fund, as a prop house, you'll have cheaper funding, you'll expand your balance sheet. So the whole shadow banking system, with interest rates going down, they are likely to expand their balance sheet, just throwing as well fuel to the recovery of the US economy. At the worst time of the tightening, worst tightening in 40 years, the US economy was growing at 2%. Right now, it's growing at 3.1%. When interest rates keep going down, it's not unreasonable to think that growth could accelerate to 3.54%. That's the reason for which we are pretty bullish on the future of North America. This year, as we know, electoral year, political cycle, we call it Volcker versus Barnes. Paul Volcker, the guy that killed inflation in the early 80s, Arthur Barnes, the central banker that created it under Richard Nixon. We are under this tension, and it's widely known that in an electoral year, the Federal Reserve, following typically an orthodox approach, when they have some discretion, they tend to have a more loose monetary policy. Why is that? There are ways in which pressure can be exerted onto the Federal Reserve. Some voting members of the Open Market Committee, they are the heads of the regional feds in Chicago, in Texas, wherever. When they go back home, they'll have to explain to those that elected them why they have voted what they have voted. That's a powerful incentive. Second one is the implicit advice or threat of a closer scrutiny from the Congress on the activities of the Federal Reserve, of course, respecting the independence of the central bank, but, for example, having a look at the financial models that created the high inflation in 2021 and 2022. If you are the chairman of the Fed, you don't really want this to happen. And the third one is, of course, potential punitive media coverage. So we think that this year, the monetary policy of the Federal Reserve will be orthodox, but with a point of looseness, and that will feed a recovery that might last a number of years. And of course, a very good way, in our view, of playing this macro picture is through US banks, which are making half of the money, or less than half of the money that typically they make at the upper part of the cycle, could be 40% bigger in 5-6 years, and as well, they are pretty well priced in terms of PE. Just remember the words, too big to fail. Don't go to the regionals. The regional banks, they are where they are. They have a number of unknowns, and even if they are very good, if they get in trouble, they might not help them. But they will have to help, the Fed will have to help Bank of America. So this is the picture in the US. Now we are going to move to Europe. Usually, Europe is more complex, is more nuanced, and more difficult to understand, and a bit more dysfunctional. We presented some years ago here our vision of the Eurozone and its surrounding area. In our view, the Eurozone has become fundamentally, to a point, dysfunctional after very strong internal devaluations of two of its biggest partners. Germany devaluated unilaterally labor costs in 2004, around 35%. Spain devaluated in 2012 labor costs around 38%. Now, if you are inside the Eurozone, remember, you cannot leave. If two of your key trading partners are devaluating, you have to do the same. Otherwise, you are at a disadvantage. The companies of your partners are going to go to your country. They will sell you equal quality at a cheaper price, and they will tend to ruin you. That's a bit what is happening in France with the agricultural sector. Hence, the quite well-fundamented, in some cases, complaints against production from countries such as Spain and Italy, which is the high quality and tends to be better priced. So Germany and Spain devaluated. The French tried to do it in 2014-15 with Macron. They didn't succeed. The Italians with Matteo Renzi tried to call a referendum to have the political capital to devaluate, and they didn't manage to do it. So right now, in terms of internal trade dynamics, the Eurozone is quite unbalanced, with significant surpluses in Spain and Germany and corresponding deficits in other countries. This has a very negative impact on the banking sector. If you are a big French bank and the companies you have lent to are, some of them, not able to compete, they're not going to pay you back. That means that your non-performing loans will increase and your stock price will suffer. Is that happening inside the Eurozone? Optically, the results of French and Italian banks are not so bad, but there are a couple of ratios which are very strange. BNP Paribas dividend yield is around 7.7%. It has been at this level structurally for 5 or 6 years. Crédit Agricole dividend yield is 8.2%, as well, far higher of what it should be structurally. That means that the market doesn't really believe the picture that these banks are painting, true or not, and that they don't think their profits are sustainable. So this is, in our view, a clear example that the banks in certain core European countries are suffering due to a macroeconomic situation, internal devaluation inside the Eurozone, which is quite difficult to reverse. Finally, the puzzle of the COCOs, the convertible capital from banks. As we all know in this room, it has been yielding around 8, 9, 10% interest rate. A hybrid, theoretically well protected from big banks. Why is that? You think this is an aberration that has an explanation based on this macroeconomic situation. COCOs are pricing the possibility, small possibility, of that at some point the European regulator tries to clean the table, shows what is really going on in some of the biggest banks in the Eurozone and recapitalizes them. That means that, yes, you had your 10% coupon, but now you get converted in shares at a deeply discounted rate and you lose a lot of money. That is the reason, in our view, for which COCOs has been so high for so long. They are pricing some potential risks that maybe, probably they won't materialize, but if they do materialize, the holders might lose a lot of money. But that's not enough in Europe, because the Eurozone is quite macroeconomically unstable, but it's the big elephant in the room. It's the big monetary area that exerts its influence in the smaller countries around, especially the Nordics and Switzerland. How does it happen? This is called technically monetary externalities. When the European Central Bank implements a quantitative easing program or raises or lowers interest rates, everybody around the smaller economies are going to be impacted and they will tend to suffer. We can see this in two examples. The blow up of the Swiss franc cap in 2015 and the, in our view, quite negative externalities that the European monetary policy is having on Swedish banks. In 2014, the ECB implemented its quantitative easing, and many investors just exchanged their euros for Swiss francs as a safe haven, and because, you know, in relative terms, there are going to be far more euros than Swiss francs. And that created a big problem for the Swiss Central Bank, because on a compare basis, Switzerland is a small country. If the exchange rate kept increasing, that would hurt Swiss exporters, and it could become a big problem for the whole macroeconomic picture. So what did they do? They started printing themselves Swiss francs to try to keep the situation under control, to keep it, and buying dollars, buying assets around the world, just to try to keep the exchange stable. But that was not enough, because the Eurozone is a big elephant for these smaller countries, and at some point they realized that to keep this exchange, they would have to print so many Swiss francs that they would go around the world, they could be used for speculative purposes and endanger their main business, which is finance. So at some point, they let the Swiss cap so-called blow up, and the Swiss franc kept increasing, and it's likely that it will keep increasing structurally for the foreseeable future. This is damaging Swiss exports, industrial exports, but at least it maintains stable its main business, which is the financial sector. The second way in which these externalities from the ECB are creating lots of problems in the nearby countries is the impact on Sweden and Denmark. Sweden and Denmark didn't go through a very strong crisis in 2008, at least on a compare basis, so they recovered and they kept growing. That's fine. They kept increasing their macroeconomic imbalances, which is perfectly fine. So at around 2014, they decided, the Riksbank, the Swedish Central Bank, decided to raise interest rates, you know, create a mild recession, and then clean the table and start growing again. But at that point, the European Central Bank implemented its quantitative easing program and brought interest rates to below zero. And that put the central banks of Sweden, Denmark, and others in a lose-lose situation. If I raise rates to control my macroeconomic problems, I will have very high rates in Sweden, negative rates in the Eurozone. That means that every single fixed income manager in the Eurozone will try to move their money to my small country. That means that my macro imbalances that are going to become far, far worse. So I cannot raise interest rates. I'll have to lower them to avoid this situation. But hey, then you are lowering interest rates in the middle of a bubble, real estate and financial bubble, so you are throwing gasoline to the fire. Whatever you do, you lose. So the Eurozone with its regional monetary might, is creating very strong problems for the countries around. And that is making the banking sectors of some of these countries quite fragile. I'll give you another example with my favorite ratio, which is dividend yield. Handelsbanken, the biggest real estate lender in Sweden, has a dividend yield of 10.6%. Swedbank has a dividend yield of 6.52%. We're talking about dividend. So that means that the market doesn't believe at all that the earnings of these banks are sustainable. Given that the Eurozone is inherently internally unstable, and that is damaging the banking sectors of a couple, at least, of core countries, and as well, it generates quite negative externalities around, we think that is the time to change the way of thinking about Europe. 2008, it was center versus periphery. In 2024, it would be more Eurozone and its very strong externalities, and versus Eurosides, which are the countries around Switzerland and the Nordics that are going to have to take them on a structural basis. In terms of banking sector, obviously, we have not invested never in Europe for this reason, because the whole banking sector of a number of countries is stable for one reason or the other. The conclusion, the US is to outperform Europe and drag the whole continent to the upper part of the cycle, but of course at a lower level. That is what always happened when the US starts firing at all engines. It will drag Europe and it will drag others, but they will grow very likely at a lower level given the situation that they have, that we have just explained. And finally, we have had a look at the next 4 years of the macroeconomic and macrofinancial expectations. Now we are going to have a look at the big elephant in the room, the device that could change the financial sector in the Western world and around the world in a way in which we are absolutely, to a point, unable to understand. And that will be driving this device is the central bank digital currencies. This strange tree that you see here is not a drawing of a kid or an eccentric academic. This was a presentation given by the head of research at the Bank of International Settlements, which is the central bank of central banks. They are investing big resources to plan and to deploy central bank digital currencies very soon. And that is for a reason. In our view, they fear cryptos. The anarchic growth of cryptos has created a market cap of almost 3% of world GDP. So the market cap of all the cryptos has reached 3% of the world GDP right now. If this keeps growing and it reaches 7 or 10%, the central banks will have a very serious problem, because that can filter to the economy, it can create inflation, and as well it can make monetary policy to an extent unworkable. So central bank digital currencies are the counterattack to try to control and, if possible, to destroy crypto. CBDCs are basically a digital version of dollars or euros that are going to work with a blockchain or a blockchain-like ledger. They are going to take some of the businesses that cryptos are entering right now. And they are doing it because blockchain is a better way of payments than any banking network that we might have. It's automatic and it can be programmed. For example, if I'm an importer of Indian goods, I can program a transaction through blockchain that says I will pay when the goods are unloaded at the port of Valencia. If you want to do that with documentary credit, which is the traditional way, is a far, far more burdensome process. This happens with a number of financial businesses, international trade finance, forex, mortgage brokerage, bank deposit brokerage, which are being taken, or they will be taken by crypto's venture capital. So central bank digital currencies is a way of doing the same, but based not in air, but in sound euros or dollar currencies. They are going to be deployed during next years, so you can find a situation during next 10, 15 years in which you still have cryptos, they are not going to destroy them, but you have still as well central bank digital currencies with all this myriad of businesses, and as well you have fiat money. So a really big mess indeed. And by the way, fiat money is, as we know, political to an extent. When the next big crisis comes, central banks will print more money because they have to. So they will print CBDCs as well. That means that cryptos will stay in the market, especially coins like Bitcoin, because they cannot be manipulated in any way. So things are going to change if they implement that during next 15 years in a way in which is quite unexpected. We are going to find 3 kinds of currencies and a myriad of businesses interacting with each other in ways that we don't expect. That is a lot of trouble and a lot of opportunity. And I say again, this chart comes from the head of research at the BIS and working for the management. So they are the central bankers of the world. It's not some individual, some academic. It comes from the top of the central bankers. So summarizing, looking at the short to midterm picture, we got a expected strong growth in the US and Canada, subject to unknowns and knowns. You never fully know everything. You got a situation which is quite complicated, with more or less a stable Eurozone exerting its power in the area around, and then you got the big elephant in the room, which will be deployed during next 10, 15 years and might very well change everything. In terms of investments, we are very in favor of US and Canadian banks as a way to capture the strongest recovery that we perceive will be the strongest recovery. Europe will be dragged out of its problems by US growth, but the banking system, in our view, has very, very serious problems, or at least serious problems in a number of countries. And then everything might change with central bank digital currencies, or maybe not. So this is a bit the very quick summary of what's going on in terms of macro and the future of the financial system. So now, happy to take any questions.
Thank you. Any questions?
Are you saying Bitcoin is not going to zero?
Oh, I have no idea. I have no idea, but you go to a situation in which probably cryptos will be there, but you'll have other forms of money. And that nobody knows exactly how that could interact. The only country that launched already CBDC that I know about is China. But the project of the ECB is very advanced, and the project at the Federal Reserve is very advanced.
The Fed is going to turn off the repurchase repo program soon, and this was adding a lot of profitability to the US banking system because they were borrowing to the repo and lending it to the Fed. And that's also something that increased the liquidity in the system. But when this will close, do you think that my first question is, do you think this will impact negatively the US banking system going forward? My second question is commercial real estate. You're mentioning the regional banks. What's going to happen with New York, NYCB? They bought SVB's assets, and now the bank is collapsing again. Is this a systemic risk? I mean, the balance sheet is still 120 billion. It's like 6 times less than Lehman, but it's not insignificant. And my question is the US banking system really that it's such a good shape?
Big banks are in good shape. The regionals, they have unknown unknowns, and if there is another crisis, even if you are a well-managed regional bank, maybe they'll let you fall. because they find something inside you, because whatever reason, but they cannot let Bank of America fall or Goldman Sachs fall. And when everything goes up, all these problems tend to disappear. If you have a very strong recovery, all these problems you are mentioning will disappear. There is an issue with the commercial real estate, but I'll tell you something. If things get complicated with commercial real estate, which is mostly regional banks, and that endangers the recovery of the whole system, the Fed will put the money. So you might have a bit of a bump, but if the economy keeps growing strongly, you should recover through the cycle.
Thank you so much.